So welcome everybody. We're delighted to have Miles Staude with us. Miles is based in London. We're doing this, we typically for our webinars, as you may know if you've been on the webinars, we tend to focus on, I guess, family or education topics. But we thought we would try something slightly different and see how that goes. And Miles was introduced to us by one of our members based in Sydney, someone who we feel has pretty good judgment. And we know that we felt that the case study of what Miles has been involved in around the Blue Sky Alternatives Fund might be relevant. Very interesting as a case study in and of itself, a case study of value investing. And secondly, quite relevant to some of our members, I suspect. So Miles, perhaps if you'd like just to introduce yourself and your firm. I think you were originally from Sydney. Introduce yourself and your firm and just tell us what you guys do, what your investment strategy is.
Sure, thanks Richard. I guess also I'm Australian, hopefully the accent hasn't totally disappeared. I left Australia 15 years ago now, and I've been in London all of that time. I was very lucky to go to London and join a large hedge fund. I spent 10 years in a large hedge fund, learning all sorts of interesting different investment strategies, and the one that we've I guess specialized in today is this. It's a value type strategy. Basically, we go around the world trying to find discounted asset players. So our view is it's very hard to outperform markets these days by picking stocks and bonds. Instead, what we try and do is effectively invest into the market at a discount, buy assets for, say, 80 cents on the dollar. And then through a number of tools that we have, and primarily activism is the one I think we'll be talking about most today, we go about unlocking that value. So what we try and do in our little world is provide our investors with two sources of return. The returns from the underlying assets we bought at a discount, and then hopefully this second source of return, unlocking those discounts, often through shareholder activism and like a very hands-on engagement type of strategy. The team and I are based in London. We invest internationally. Though the fund that I manage currently is an Australian fund, so I'm back in Australia quite often meeting with our investors, and that's how we had a chance to have a lovely breakfast that morning. And we got chatting about BAP, which is a very interesting case study in its own right, and a very clear template of the kind of things that we do around the world in terms of value investing.
Miles, can I just ask you before we got, just to clarify, so you only invest in listed entities, is that right? So you're value investors of listed investment companies, essentially, is that right?
Well, I guess we're structure agnostic. Basically, we're looking for ways everything we own is listed, correct? And what we try and do, the philosophy is really to buy things that are trading below breakup value. So, value investing is a strategy that doesn't have a lot of friends at the moment. Where we're quite different is we have a very hands-on kind of approach. So we find really cheap value, but our key guiding principle is everything we buy is below breakup value. So we work with boards and management to unlock value, and we're often very successful like that. But the fallback that we have is we often do put things into liquidation to unlock that value. So it's a bit different to sort of a typical value investing strategy, which is sort of to buy value and wait. I guess we buy value and we are the catalyst to unlock the value. We often invest in listed investment companies or closed-ended funds or other sort of analogous structures, REITs, holding companies, basically anywhere we can buy a portfolio of assets trading below book value. That's probably the mantra.
Yeah. Okay. So I suggest we have a look at the Blue Sky Alternatives Fund, which is listed on the ASX. Why don't we put that slide up, please, Jackie, if we can? And just talk us through the whole case study and a bit of the history for those who...
Yeah, look, there's quite a big backstory to all of this, and I suspect you and many of your members will know it reasonably well, but let me go through it just in case not everyone has all the details. This investment we've made here was in a listed investment company called Blue Sky Alternative Access Fund, but it has been entirely intertwined with a very sad story for the management company, Blue Sky Investments. Just to sort of paint the picture, Blue Sky Investments, Brisbane-based firm, for a while was sort of this wonderful, or was perceived to be this wonderful Australian success story. You had the best and brightest from Brisbane who'd worked in KKR and Oaktree and Goldman Sachs all around the world. And come back to Brisbane and started this new private equity firm, basically trying to be the KKR of Australia, and with a lot of very smart people in the room. In truth, they were possibly better promoters than they were businessmen, and they built an empire very quickly of a management company that managed somewhere between $2 and $4 billion. Along that way, they sold the management company to the market. So they listed it, took the company they built public. And I think the shares from the company went from $1. This is the management company I'm talking about, went from $1 at IPO all the way up to $10 very quickly. And there was a lot of hype and possibly over enthusiasm about the story. What happened, and this is where I guess the press becomes very important in part of the story. What happened about 18 months ago was they were subject to a short seller's attack. So the company itself, the management company, face value was a very expensive piece of paper. Most people in the market understood that, and they became subject to an offshore short seller's attack. So basically a big opinion piece on why the company is tremendously overvalued and not worth owning. And the short sellers made three key accusations. One was the share price is ridiculously overvalued. And in truth, that was probably true. At $10 a share, the management company was trading at nearly 3 times what a KKR in London was actually, in New York was actually trading at. So you've got a big, proper established private equity business that's been around for 30 years, and you have a small startup in Australia that's trading 3 times as expensive. So the hype had probably gotten carried away. The second accusation the short sellers made was that they didn't manage as much money as they claimed they did.
Was that the head? Sorry, was that the head company that you said 3 times?
Yeah, that's Blue Sky Investments, which was the management company, which managed somewhere between $2 and $4 billion, and they built from basically zero to this multi-billion-dollar number. I'm being vague about the number because I'll explain in a minute. Very quickly, and it created all this hype. And they listed their management company. So it'd be like if I listed my management company, sold it to the stock exchange like Platinum does or Magellan does, and the share price of the management company had been pumped all the way from $1 to $10. So there's a lot of excitement about this story. And in truth, they were doing something quite new in Australia, and they were very good promoters. But I think history shows that the whole story got very carried away.
Can I just jump in? If you would like to ask a question, if anyone on the webinar would like to ask questions, I believe that you can unmute yourselves. We don't normally do this, but I think that we are able to do this today. Jackie, operating the webinar, I think has allowed people to ask questions. So jump in, but carry on, Miles, before I
Yeah, so I guess I'm just trying to set the scene. So the scene is we have this management company grown from zero to a huge multi-billion-dollar asset manager very quickly. Its share price has gone up tenfold in a couple of years, and it's been subject to the short sellers attack. And the short sellers have made 3 accusations. 1, ridiculously overvalued, probably true. 2, you don't manage as much money as you're out there claiming, which seems like a really obvious thing to be able to prove wrong. And 3, the one that we'll spend some time talking about, is that you're mismarking your assets. And in the world of private equity, investing in private markets is a very different kind of animal to investing in public markets. And there's a whole universe of nuances that you need to understand. But I guess one of the key ones is, and it sounds a bit cavalier, but the managers are mostly responsible for valuing these assets. And you can obviously see a big conflict of interest there. The managers getting paid on the value of these assets. They generally get paid a percentage fee. So if they're managing a $100 million asset and they earn 1%, they make $1 million a year. But if the asset's really only worth $20 million, they're massively overpaying themselves. So they claim.
Normally the case, Miles? Is it normally the case that the manager is valuing the assets and managing them?
It is in private equity. It is, but it's nowhere near as cavalier as that first sounds. And that little piece of information I've given you is something that press grabbed a hold of, and that press here is a really important part of the story. But in truth, when it's done properly, there's all sorts of checks and balances in place, not least of which, especially in developed Western countries like Australia and the US or UK, is all of these assets have to be audited. So an independent auditor, normally a Big Four accounting firm, has to come through and validate all the valuations. And ultimately, there's a strict process that goes into the valuation policy. And normally, in a healthy environment, you have a lot of outside input into that. External valuation agents coming in and reviewing the valuations, then the auditor has to approve them all. And then ultimately, the assets, hopefully, the private equity model, you buy these assets for a business, you revamp it with all your new strategies, cut costs or grow revenue, and then you go and sell it. And it's not until the assets are sold that you actually ever really get a final valuation mark for these assets. But it is a grey area. That's one of the risks and rewards for investing in private equity, that it is a bit of an unknown in terms of what you're actually owning until the assets are finally sold. Big difference to the public market, obviously, where every day you know what the value of what you own is, because like our portfolio, we can mark to market it every second of every day. In private equity world, the valuations is is a really sensitive subject. So this is not new. The press hasn't rediscovered something here, but it's an important subject that people in the industry are aware of. Anyway, those are the three charges that short sellers made. The first one was blatantly true. The stock at $10 a share was enormously overvalued. Share price for the management company started to fall very quickly. And then where things got really hairy for them, and this sounds almost too simplistic, but they had been out in the market promoting that they managed $4 billion of assets, which is quite a big number. And in truth, they're only managing closer to $2.5, $3 billion. Where did this extra $1.5 billion come from? What they've done, and this is it's an overly promotional technique, which this is my view. I don't want to get into sort of legal trouble, but it's, in my view, a very heavily promotional technique. And what they've done was they were doing a lot of property development, and they had bank facilities that would let them borrow another $1.5 billion to build the complexes and student accommodation and care home facilities they were going to build. And they were just looking into the future and saying, well, when we draw down that $1.5 billion in debt, we'll be managing $4 billion in assets. The market, when that sort of key piece of information was blasted across the press, took an enormous amount of fright. And now the management company fell all the way to sort of $1 or $2 a share. Ultimately, the management company went into administration. Throughout all of this, the press had an absolute field day. And the press is really good at sort of highlighting issues like this and drawing market's attention to them, but not very good at actually doing any analysis of what's going on underneath. So there was a veritable, and I'm sure your members and yourself would have seen, there was a veritable hurricane, horrendous press for Blue Sky throughout last year, culminating in the share price starting at $10 and going all the way into administration, the company, and a lot of people losing a lot of money. It was quite sad. In the middle of all that kind of that hurricane of negative press, they were managing a listed investment company. This is where we get involved. BAF. It only has about $200 million of assets. That's not a particularly big fund, but it's a listed fund, listed on the Australian Stock Exchange, and it invests across a diverse spectrum of quite interesting agricultural assets, private equity assets, and other real sort of farmland and infrastructure assets.
Quickly, the hurricane of negative press. I don't know, you probably don't know a direct answer to this, but in your opinion, was that partly intentional by whoever the key short sellers were?
Oh, that's a nice little conspiracy angle. I don't think so. I think what normally happens, in my experience with the press, is that the press is just desperately hungry for content these days. And unfortunately, I think press standards have gotten weaker and weaker over the years as they've had to compete with social media and all this kind of stuff. So you don't have journalists can do in-depth reporting like they used to. And if you speak to journalists, they'll agree with what I'm saying here. So what often happens is they're just looking for the headline. So what happens? You have this success story that everyone loved, suddenly turns into a disaster, and the press were publishing all sorts of salacious stuff about how he was getting paid how much, and all these executives are now parachuting out with all these millions of dollars, all horrific stuff to read, and not at all the kind of stuff you want to be associated with. But within all of that, for us at least, we found a really interesting opportunity. Basically, no one wanted to be involved with the Blue Sky franchise anymore. And in that hurricane of toxic press, this little listed investment company that had $200 million of asset went from trading at about a 10% premium to book value to trading out to nearly 65 cents in the dollar, so 35% discount. So the proposition for us, we were watching this maelstrom of negativity, and we're looking at the things that we look at, and suddenly the proposition for us is, wow, we can potentially buy a portfolio of assets here at 65 cents in the dollar. That's really interesting. That's really, really cheap. There's quite a big margin of safety in that. We always do a lot of due diligence, and one of the key charges in this vacuum of poor press and the short sellers attack was that the assets had been poorly marked. There was some sort of nefarious accounting issue going on, and we did a huge amount of due diligence on the assets themselves. We came to the conclusion that the assets were actually really fine. And I'll talk about that to the slide in a minute, but that was essentially the bet we'd made. The team and I had done enough work to go, the press has made far too much out of some of these small assets that have not done well and are not focusing on some of the key parts of the broader Blue Sky business and that are in this portfolio. And these assets are tremendously cheap. And I'll give you sort of the headline numbers on how cheap it was, just hopefully to give some comfort about the kind of things that we look for. Today, there's probably, and the numbers have changed a little bit, but this is still basically the same proposition. Of your $200 million in assets, about a third of that portfolio is just cash sitting in the bank. So you don't have to worry about how anyone values that. It's a dollar's worth a dollar. Another third of the portfolio is this investment in a series of water rights, a water fund. And we all know that the drought's been terribly sad, and And it's been really a lot of hardship for the farmers around Australia. But the flip side to that is anyone that's invested in water rights throughout this period has made a huge amount of money.
This
And
is
these water,
this is your graph on the bottom left, right, of the slide.
exactly, yes, exactly. You can see there. So 29 cents in cash, then 34 cents in water rights. Now the water rights are tradable instruments. They get independently valued every month by third-party valuation agents and Sitco and administrators. So you should have a lot of confidence about what those assets are worth straight away, regardless of what the press is talking about burrito chains and shoe companies. This is where the bulk of the value in this portfolio is, these water rights. Again, we did all our own work on the water rights, got very comfortable with them, but probably the easiest way to get comfort with them is that Chris Corrigan came along and made a takeover bid for them. And, you know, Chris Corrigan is not the kind of guy that wants to buy something off you if he thinks it's worth $1. He came in and made an unsolicited offer for the water rights at book value about a year ago. So now the way we're looking at it is like, well, we don't have to worry about the cash. We've got someone who's willing to buy the water rights tomorrow at book value. And by the way, we think they're quite an interesting investment. So the rest of the portfolio that the press is all caught up about, we're basically owning at 30 cents in the dollar. And there's no way that these assets are worth that little in the context of the audit process that has to go on. We have a good understanding of how private equity works. And yes, there's a variation around asset values. Whatever you think an asset value might be worth, it, you know, if you come up with a value of $1, maybe when you finally come to sell it, it's worth 95 cents or $1.05. It's certainly not worth 30 cents, not without fraud or you know, malfeasance going on behind the scenes. That was a bet we're willing to take. So we built a large position in BAF at the end of last year, basically at 70 cents in the dollar was our entry price. That's the first part of the proposition for us, and that's probably where some of your listeners started to get a bit, if they were shareholders, obviously a bit angry, or if they were following the situation, probably a bit curious. Next part of the proposition for us is how do you get that value out? And that's really the key IP that myself and my firm has. Finding cheap assets is by far the easier part of the equation. It's a long story. I'll sort of hit the highlights quickly, but basically at the end of last year, once we built our large position, we engaged with all the other key stakeholders, the shareholders, the board, the manager, of course. The board at the time, the old board, was pulling in a direction we didn't think was very helpful at all. We tried to reason with them. I spent a lot of hours and hours on conference calls and emails and letters trying to rationalize with the boards that they weren't doing the right thing for the shareholders. Ultimately, they demurred. And so in response, we fired 2 of the 3 directors. We were a key part of that process of removing 2 of the 3 directors this time last year. At the start of this year, we had a new board all pulling the right way. And I was very encouraged, sort of January, February of this year. The idea was we would reboot the story by bringing in a new manager. So someone to validate the investment thesis, and it's still quite an interesting proposition. The assets themselves are doing quite well, despite all the negative press. It was enormously cheap. And we were finding a manager out there that we thought that could revitalize the story. Where we got a big hiccup, and in hindsight, I feel a bit naive, you know, looking back on this, but I think it's probably fair to say that it's hard to foresee this. The management company, this is back to the management company that's gone from $10 a share to $1 a share, and now it's trading about 20 cents a share. They went and took a mercy loan from Oaktree. Oaktree, a sort of famous California vulture fund. They came in and lent the Blue Sky Management Company $50 million on horrifically punitive terms, with the idea that that would be a short-term bridging loan for about a year or 2 until they got themselves back on their feet. Just as a little insight into perhaps how the original management story had become overly promotional and perhaps not the most business-minded proposition. I mean, they were still managing about $2 billion. I mean, that's a big fund management business. Even managing that much money, they were running cash flow negative. So the business itself wasn't able to pay its own way, just in a static state. The whole business being predicated on growth and performance fees and upfront fees from raising new funds. Anyway, they raised their $50 million from Oaktree. Within 3 months, they'd gone default on the loan. And that happened in about March. So at that time, I took a bit of a shock. We're in the process of trying to unlock value from this situation. Suddenly the management company, the person that's the custodian of our assets, has gone into administration. And I know from my own experience, I've dealt with Oaktree many times in the past. I mean, they're there to look after Oaktree. And I've certainly seen a lot of situations where value gets leached out of these propositions when you have shall we say, an aggressive actor like that on the table that's there looking after Oaktree, perhaps not all the other stakeholders in the situation. What I did was I called up the board of BAF, explained that I've been talking to these directors a couple of hours a week, every week for months now, working how we can unlock value, having removed 2 of the 3 directors at the end of last year. And what I offered was that I would come onto the board for free. I have a certain skill set of doing this sort of stuff. I've done it for a decade all around the world. And really what we were trying to do was to find a way of extracting ourselves from the Oaktree proposition whilst unlocking value for the benefit of BAF shareholders. And broadly, and what's happened, and this is probably the crux of the story, over the last 6 months, there's been a furious negotiation going on behind the scenes. You have Oaktree on one side that have been trying to ensure that Oaktree's best interest are looked after. You have myself and the BAF directors on the BAF side. And I know from an outside perspective looking in, it's probably taken a lot longer than what shareholders might like, but it's been quite a robust negotiation whereby we're trying to divorce ourselves from Oaktree, who still has 4 years left on the management company, even though the manager is now in administration, and find a new path for the company. Overriding all of this, and this is the key part of what we do have the ability to put the thing to liquidation. And I know that's not what a lot of BAF shareholders would necessarily want to enlist an IPO, and it's obviously a very sad thing to do and not the sort of thing we do lightly. But from a GVF point of view, or for shareholders today, given the hardship they've suffered, liquidation would still be a wonderfully good result. If we take the cash out of the business, we get the water assets out, we sell them to Chris Corrigan, or we just redeem them out of the fund, we're left with a proposition where we're taking through the liquidator assets valued at 30 cents on the dollar. I know when I'm on the board overseeing things like that, GVF and BAF shareholders do very well from the current share price, and that's the proposition. So what's been going on has been a very robust negotiation between Oaktree and myself and the BAF board. And where we've gotten to, what we've announced recently, while the share price has bounced up a lot, is that we finally managed to come to agreement on the key commercial terms. Just one last thing to say on that. I mean, you can't negotiate a good deal with someone like Oaktree unless you're willing to work away from bad terms. And I know it's probably been frustrating for a lot of BAF shareholders over the last 6 months, wondering what's going on and why it's taking so long. But in the context of, it's a very messy procedure to extract ourselves from the old management agreement. We're trying to put in place a new management agreement with a new company that we think can revitalize the story. In the background, preparing legal framework for liquidating the company if we had to. Very time-consuming very time-consuming process, and perhaps a bit of game of chicken with Oaktree in terms of making sure that we get decent terms from our shareholders. So that's sort of the the story in full. What we've announced is that we've decided that we've announced key commercial terms with Oaktree on the divorce. So we believe we've now settled the key monetary issues that were outstanding to separate and go on our own way. And once we finalise that, what we've announced, and this is the BAF board has put this out publicly, is that we'd like to bring in a new manager, and that manager that we've picked is Wilson Asset Management. They're probably the premier LIC manager here in Australia. They manage, I think, 5 or 6 LICs, most of which trade at a premium. And I personally think they'd be a wonderful manager in terms of coming in, revitalising the story, and getting rid of that discount over the next year or two.
So I'd just like to open it up if anyone has any. I think it is an interesting case study. It's quite kind of complicated and gnarly and interesting to see what's going on.
A few moving parts.
With the Oaktree situation. Does anyone have questions? I hope people can speak. Maybe, Jackie, I assume people are open. Speaking. Any questions? If you're having trouble, maybe no one wants to ask a question, but if you do, can you maybe put a note in the chat box? There's a Q&A box at the bottom. Because we haven't opened our webinars up to questions like this before.
Perhaps, Richard, while they're loading or people are thinking, I might just sort of answer 1 or 2 questions that I've had. I mean, one of the things that I touched on was there has been this charge in the market that there's a problem with the underlying assets. And I have to be careful what I say, but what I can say is that I was on the BAF board through the process of signing off the end of year accounts. And I saw how much due diligence that went into the valuation of each of those assets. And the process broadly is that you have the manager's valuation, like I spoke about, which is obviously a source of conflict, or source of potential source of conflict. Then what the BAF board does is it pays to go and get an independent arm's length valuer to come in and revalue all the assets. And then separately, the auditor comes in, Pricewaterhouse, who have their own in-house valuation team for these specific assets, and they revalue those assets as well. So you basically end up with 3 very detailed valuations of these unlisted assets. And it's the BAF board's job to decide which value is appropriate. I don't want to speak out of school, but I think when we put out our full year results, we highlighted the fact that we were very conservative. that we took the lower of in all situations, and that indeed we actually took a number of write-downs beyond what the manager was guiding was reasonable. So my own view, and I'm speaking more now as a GVF investor than a BAF shareholder, I feel very confident in the underlying values of what we hold. The water fund is by far the biggest driver of the economics in this fund, and it continues to perform tremendously well for sad reasons because of the drought. But for putting that to the side, it's been a wonderful investment. And even while the portfolio that we own, BAF, has a third of its portfolio in cash, it's sitting on a huge amount of cash drag, despite the fact that a third of the portfolio is basically not in action. The portfolio still is at an aggregate generating quite a healthy return. So I'm confident that that original charge that there's something wrong with the assets isn't correct. And to date, that certainly has been the way it's played out.
Miles, there's a question here from an anonymous participant. Have any criminal charges been laid in this case in relation to the pricing and final collapse?
So any criminal charges in relation to the pricing and final collapse? Now, I assume you're talking about that with the questions in relation to the management company, not the investment company. So there, what I think I've read in the paper, that in my caveat, I believe that a number of law firms are looking at undertaking a class action lawsuit against the management company. It's probably not within my realm of expertise to talk about the validity of that. We didn't pay a lot of forensic attention to what was happening with the management company. I know a lot of people are quite frustrated, having seen the thing go into liquidation. You've obviously most likely written off all your investment in that. In terms of criminal charges, one of the frustrations with capital markets is that when things go wrong, as long as everyone's followed the rules, that's really kind of the risk you receive for the reward you've sought out to achieve, I guess. I don't know if there's any, despite all the noise the press has made and despite the fact that the shares got tremendously perhaps overvalued, I guess the mantra of capital markets is it's buyer beware. And I don't know if there's a really firm basis to believe anyone's done anything criminally wrong. One area where they're very sensitive about, I know, is that they did a capital raising just before all the troubles hit. And that is certainly grounds, happy hunting ground for class action lawyers, because a lot of that capital raising went to retail investors, and there would have been a big disclosure exercise before the problems occurred. But I guess crucially, in terms of the three charges that have been made, the first charge was company was, considerably overvalued, but that is a subjective thing. The market decides every day if something's properly valued or not. The second charge was they're not managing as much money as they said they would. Well, I think that's outrageous, the way they promoted themselves as managing $4 billion. I think they, from a legal point of view, buried in the fine print somewhere, I would guess that they clarified that it was actually $2.5 billion of equity and $1.5 billion of debt to draw down. Perhaps that's a misleading statement for them to make, and maybe a lawyer should be the one to answer that. And then finally, that they've mismarked the valuation of the assets. There's certainly been no evidence of that. That would be by far the most serious charge. But you have, PricewaterhouseCoopers has ordered this, going through all of this stuff. And to date, there's, and certainly my experience having poured over these assets now for a year and a half and having the benefit of sat on the board, I've certainly not done anything that's concerned me about the assets themselves.
Yeah.
Maybe one last thing I would just say, because I suspect this might be a follow-on to those types of questions. I mean, I'm just going to repeat what I've heard in the press. I'm not giving any insights to what's happened, information I might have got at a BAF board meeting, but what the press has highlighted is that Oaktree made a $50 million loan to the management company, that Blue Sky Investments, and then the make-whole figure on that was $90 million. And that's press reporting, not my insights. If that's true, what that would mean was that Oaktree made a $50 million loan that said if you breach the covenants of your loan, you have to pay back $90 million. Outrageous kind of usury, that's opinion-based language, but usury kind of interest rates and penalties. If that $90 million is true, and this is where I'm trying to head, it would be reasonable to speculate that there's probably nothing left for the administration process for Blue Sky shareholders. I'm not talking about the LIC, I'm talking about the management company. If that $90 million number the press has reported is true, I would imagine that after the administration process is finished, there won't be anything left over for regular shareholders, which would be very sad and frustrating. Unfortunately, falls on the management team and the loan they took from Oaktree on those terms.
Okay. Any other questions anyone would like to raise? Oh, hold on. There is another question here that's come up through a different channel. I just want to confirm, who are the actual managers of BAF? And is there any overlap with the management company?
So you have the legal structures and then you have the people. I guess the main thing to highlight is the people, the actual managers of the assets remain in place. They continue to manage the assets today, and all the assets themselves into the BAF portfolio I'm talking about are all entirely legally ring fenced. So the management company, the management entities that's gone into administration had a number of subsidiary companies. Those subsidiary companies are the managers of these assets. They're entirely, and the assets themselves are entirely ring fenced. So the guys that are managing the BAF portfolio still turn up to work every day. They're still getting paid a salary. The salary is now getting paid by Menta, which is the administrator that Oaktree's put in. I think the way to think about it is that what Oaktree's done, it seems to be, from what's been announced publicly, is that they've come into the old Blue Sky management franchise and they're reorganizing the whole business, and they're basically going to take over the management franchise. So they've been spinning out the old management team. So the most valuable one, I guess, was the Kim Morrison's Real Assets franchise that manages the water funds and a whole bunch of farmland. That's now been set up as a separate management company. These are all just restructurings that happen in an administration process from a corporate point of view. In terms of BAF, the water assets remain in the trust. No one else can touch them except BAF and other trustees. And the people managing those assets still turn up to work every day. They've been paid by the administrator, and soon they'll be, I would imagine, getting paid or work directly for Oaktree.
Is there any overlap with the Blue Sky Management Company, between the managers of BAF and the Blue Sky Management Company?
Overlap in a corporate sense or in a personnel sense? But how would I?
I think the question means the personnel sense, the managers.
Yeah, so definitely, look, a lot of people have left. The old management companies, basically, this is how I'm reading the situation, is going to be wound up and absorbed into a new management franchise that Oaktree runs or sponsors, probably owning minority stakes in a number of the manager teams. So that you have a private equity team that managing a couple of assets for BAF, assets for other former Blue Sky investors. That team will remain in place, maybe with a few personnel changes, but the key guys still remaining there making the decisions, that they will no longer be part of the Blue Sky franchise. They'll be part of an Oaktree franchise, I think is the way to say it. In the old Blue Sky management business part of it, certainly a lot of people have left. But in terms of what is, and I'm kind of selfishly focusing mainly on BAF. In terms of who's managing the BAF portfolio of assets, those teams are still in place, and we have regular contact with the managers, the individuals I'm talking about. And whilst they're a little bit distracted by the corporate restructuring that's going on around them, that's really up to what Oaktree want to do as the key creditor and Menta as the administrator, how they want to reorganize things.
Another question, apart from buyback, what other methods are you utilizing to move BAF back up to its NTA?
So there's two main levers that we see, and I'll start with the less friendly one first. It is entirely possible to put the thing into liquidation. We need a vote, and shareholders would have to agree. My view is that, having lived through the pain that BAF shareholders have lived through for the last year and a half, and the time that it's taken to find a resolution, I think shareholders would be receptive to putting the thing into liquidation if an alternative solution is not found reasonably soon. And liquidation is not a terribly scary proposition. There's a large amount of the portfolio in cash, so you could theoretically return that quite quickly. Then you have the water assets, which are very attractive in their own right, and you can redeem from them on a monthly basis. It's an open-ended fund of sorts. And then you have this last third of the portfolio, which I think even at today's share price, you're still owning at 50 cents on the dollar. A liquidation of a private equity portfolio, we've done this many times around the world. It takes time. It probably would take you, 4, 5, 6 years to fully liquidate the portfolio. You won't be actively liquidating the portfolio. You'll be waiting for the managers to find exits on the assets. And that's not as, you're not as muted in that as you might sound. Like, the portfolio itself has been doing quite well. One of their big successes just a couple of months ago was they announced they sold their student accommodation assets at a 17% premium to book value. You haven't seen the press write much about that. You see the press write a lot about sort of wild breads and shoes of prey, which are sort of 1 or 2% of NAV. The student accommodation portfolio was 15 to 20% of NAV. They sold it at a 17% premium. They're incentivized to do these things, so they obviously get a part of carry the performance fee. That's the private equity model. So the third of the portfolio that's not perfectly liquid, you know, you would be waiting for it to realize over maybe 5 or 6 year period, and the money would come back. From the way we look at things, you know, that would make a very interesting IRR kind of investment. You get the decaying amount of capital back while it still grows through time. At the current share price, we would think that's quite interesting. We would much rather prefer to get the thing back to NTA much quicker. And my view is that the Wilson Asset Management team have all the ingredients to do that. They have a large franchise that doesn't have any private equity exposure to begin with. Jeff Wilson is very enthusiastic about opening this potential up to his investor base. He's gone and made a very senior hire, Adrian Su, former Carla manager, who's going to be the portfolio manager if and once the deal can get consummated. And you know, I think he manages 6 LICs at the moment. Most of them trade on a premium, and they have traded on premiums most of their life. He's got a wonderful kind of promotional network around him. And I think once the market gets away from the blue sky history, gets a new manager in there who's promoting the story heavily, and also can point to the fact that these assets continue to do really, really well. I mean, the biggest problem with the portfolio at the moment is a third of it sits in cash. It's not just sitting there idle. If you took that third out, the 2/3 that's working for you is doing really well. I believe that you probably re-rate the story much quicker that way than if you put the company into liquidation. But those are probably the two anchors we have at this point. And if we can't come to reasonable terms with Oaktree, we haven't quite finalised the terms, then I'm not going to sign up to a deal just for the sake of signing up to a deal as a shareholder. But hopefully we're very close to the finishing line now in terms of coming up with something that works for everyone.
So Miles, one final question before we sign off, and thank you for getting up so early in the morning to do this for us. So as part of the restructure, have the management fees changed or been renegotiated for BAF? So as part of the restructure, have the management fees been renegotiated for BAF? Blue Sky were known for their outrageous fee structure in the past.
Yes, outrageous is a strong word. I guess it's probably the fee structures they used were common across the private equity industry. The private equity industry has had somewhat of a renaissance over the last decade. Has made a lot of money. If you're unkind, you'd say perhaps owning anything in a bull market's not hard to make good money, but there are some very smart people that get in there, restructure businesses, and create a lot of value. And the model historically is that they take a reasonable share of the value they unlock. In Blue Sky's case, they were using that kind of fee structure. So it looks luxurious. The proof is obviously in the pudding, and to date, I guess in the BAF portfolio's point of view, they have actually generated the returns that would perhaps justify that. In terms of fees going forward, I'll just rewind. If you remember, I said I wasn't personally happy with how the old board was pushing, and what the old board, this time last year, they were trying to move the management contract to a Pinnacle franchise. And that had a fee structure that, in my view, was horrific. So currently you're paying sort of 1.2, depending on the individual assets, on the BAF portfolio and a performance fee. But the model that the old board was putting forward was on top of that, you pay another 1.2% in management fees. I think it's 1.2, plus another layer of performance fees. So you're going to pay 2 layers of management fees, 2 layers of performance fees, and you're going to hand it over to a manager that has no real history or expertise in marketing LICs. In my view, fee drag would kill the performance, and you don't have a manager, you don't have a plausible path to re-rating your story. What Jeff has announced publicly, and he announced this about a year ago, so I'm just going to relay what's in the public arena, was that he's going to charge a 1% flat management fee and no performance fee. So I view that much more favorably than the old one. There's 2 ways you can go about revitalizing the story. So the first way would be, and what the board has settled on, is sort of a best of breeds model. So the current BAF model, what you might call an in-house model. So basically, as an LIC, it only invested into BAF products. And that has benefits. Theoretically, you can get maybe a slightly better fee deal on the assets that you invest into, but it obviously has negatives. Your captive pool of money, and whether or not perhaps the BAF assets you're investing into are the best in the market is incidental to the fact that you're only ever going to invest into BAF assets. What we think is a better model, BAF board, is sort of a cherry-picking best of breed model. And the idea will be Wilson Asset Management will be the portfolio manager, and maybe they'll invest in some BAF products, probably not in a hurry, that they might continue to own some BAF assets, but then they'll go invest into a MOLS fund or a perpetual fund or other fund managers around town, but basically trying to find the most exciting opportunity. It will be a fee-on-fee model, and that comes with negativity. Obviously, you've got a second layer of fee drag. The art of making that work is obviously that you have to create enough value through having that wonderful, I'm not tethered to any particular manager. I can go out there, be small and nimble, and find the most exciting opportunities for shareholders. There isn't a perfect magic wand in which way you go. I think after the experience of the BAF history, where a lot of the problems that the LIC has today is that because it only invested into BAF products, you're enormously tied to the fortunes of one manager. Maybe a slightly less expensive fee model that has different kind of things you have to manage.
Miles, look, that's great. Thank you. I think it's time for us to close off. And for all of those who've joined us, thank you very much. My apologies if you have been trying to ask questions live, because I don't think that has worked. But thank you for submitting the questions in the question box. And I hope you found this seminar or this webinar helpful. It's been an interesting experiment for us. And Miles, we really appreciate you getting up so early in the morning in London and doing this for us. Thank you.
Thanks for the time, Rich. I really appreciate it.
All right, great. Thank you, everybody. We're going to sign off now and close the meeting. Cheers. Bye now.